We'll do a quick intro here. David Weston here at Hughes and Associates hosting the quarterly market call. So we will be doing this quarterly. And for those of you that we get together with from time to time, do some market updates, talk about the economy. I think this will keep us more informed when we're doing it periodically like this. And we find that the more informed our clients are, the more we can work together on helping people reach their goals. And the more that we can help allocate assets into different areas that will help people feel comfortable given any market and economic condition we have. And we'll be doing some additional seminars. We just recently did long-term care. We've done Social Security, we've done retirement planning, and we will continue to do periodic seminars for educational purposes for our clients. So watch for announcements for some upcoming things. And we'll be doing some things live in our office here and via online, via Zoom. So, for now, we're going to turn the time over to Kurt Brown, who's the head of our investment team and the head at TownSquare Capital. And he's going to give us some information for the last few months and looking ahead to see what we have to expect, hopefully, in the market and the economy. So thanks for being with us, Kurt. Appreciate your time to do this for us.
Yeah, it's my pleasure to be here. This is fun for me, and appreciate the partnership and welcome everybody that's listening to this. We have a certain number of people here live that are joining us right now, and then a lot of you will watch this on a recording later. So hopefully the information is helpful in some way. As David mentioned, we because we're using this off the Zoom chassis, there's a little Q&A chat in here. So feel free to, as we go, if you have questions, just type them into that Q&A function there, and we'll do our best to get to them. But as always, you can always follow up later. And if you have any questions while you're watching this, and we're happy to get back to you. We have a team of about 35 people here based in Utah at TownSquare. We work closely with David and with his group there on the investments for his clients and his partners. And so this is fun to be with them. And we're going to kind of go through some things about the market, the economy a little bit. David, should I just go ahead and jump into this presentation? I think you're on mute there. All right, there we go. Okay, so we'll let's just jump into this thing. So I've been married to an NBC TV reporter for 15 years, and you learn real quick that the news is not necessarily just the news, right? So what I like to do in these calls is to be able to give some data that isn't part of some spin or some narrative, isn't designed to drive stress and fear and anxiety like a lot of news and media is, right? So we just kind of like to give you some of the raw data, the good and the bad, and kind of talk how that might be impacting capital markets, financial markets, maybe your portfolio and things like that. So I'm going to turn off my video, and so you don't have to stare at me doing crazy hand gestures the whole time, and then you can just focus on the screen here. So let's jump in and kind of talk about some of the good things that we're seeing right now in the economy and in the markets. Let's start with what's arguably the most important thing when it comes to the stock market, at least, and that is earnings. And this is a surprise for people. Earnings of the biggest 500 companies in the United States are making a new all-time high. Not high for COVID, all-time high. You can see it on the screen there. And not only is that impressive, but it's dramatically ahead of where expectations were coming into the year. There was sort of an expectation that earnings would be up a lot anyways since last year at the same time, for obvious reasons. We were diving into COVID last year, but they've been dramatically higher, more than 2 times higher. And now this number's moving even higher. And so you can see that earnings are dramatically higher than they even were, where they had leveled off pre-COVID, and we were kind of stalling a little bit. The economy is really surging and thriving right now. Profit margins of the biggest 500 companies in the United States are making a new all-time high. Okay, so not only are companies surging in their growth, but they're actually running lean and mean. They're making more money and spending less. right? So margins are actually getting better. Again, this was the pre-COVID peak was in the middle of 2018, actually. So this is really impressive. I mean, the rebound coming out of COVID is remarkably better than anybody had anticipated. I mean, we track, a litany of economists and analysts and different organizations that forecast these kinds of things. Nobody had this right. So the rebound is much, much stronger. You can see retail sales, the activity of the US consumer bumping up against, 30-year highs. So you really have a consumer that's charging back, had really been sitting on their hands for a year for a variety of different obvious reasons, and now really kind of unleashing and getting back to doing everything from buying cars to traveling to everything else. Manufacturing and ordering strength, both in the US and in Europe, really strong, going back to decade plus highs in terms of manufacturing and ordering. That's a big deal. Here's used car, used vehicle sales just exploding, and really exploding as a relationship to even new car prices. For those of you that have been trying to buy a slightly used car, you know what I'm talking about. I've been in the market for a slightly used truck. You buy a truck with 10,000 miles on it, it can be more expensive than a brand new one. The market for vehicles is incredibly tight. There's a variety of reasons. One is people sat on their hands for 6 to 12 months and did nothing. Secondly, you have a lot of vehicles, as you've been reading probably, that can't get off the assembly line because they don't have the parts to get them out into the field to sell them. In some cases, it's semiconductor chips. In some cases, it's other parts. And then on top of it, you got incredibly low interest rates, so people can finance easily. And then you just have a real backlog because for a while, the factories themselves got real slow during COVID. So a lot of forces have come together. Now, this will normalize. This is somewhat normal. Look at what happened coming out of the financial crisis, right? So it's somewhat normal to have a surge in everything when you first come out of a recession because nobody's really prepared for that fast snapback. So how many people are flying, right? This is last week, and you can see we're not back to where we were in 2019, but we're getting there, and we're definitely at the highest level since COVID really kicked off a year ago. Job openings, right? People are hiring. This is the green line here, right? This is posted job openings in this country, higher than they've been in a very, very long time. Much higher than even pre-COVID levels. So we have employment slowly working its way lower and the number of opportunities working their way higher, right? This is what we need to have to see a true recovery in our economy. This is something that's very unique. And it's the savings rate in the United States. Okay, this chart I like because it shows what was the all-time low in US history we hit in 2005. And if you'll remember, this period in here was that period where everybody was taking their money and trying to buy their second, third, fourth home. There was a lot of people speculating on real estate, using all the cash they had to try to buy another rental property, a flip, something like that. And we got down to a 3% US savings rate, never before matched. Well, now exactly the opposite. We saw during COVID an all-time high 33% savings rate for a month, and we see it spiking up here again. Now, there's a couple of really important reasons this is. The first one is stimulus. We have our government decided to pay people to stay home. We employed many programs for small businesses. PPP, for example. There's a lot of injection of liquidity into the economy. What's been interesting is that in the past, when we have created stimulus, now remember, we had a fair amount of stimulus in 2008, but what happened was people spent it. So in the past, our economics textbooks sort of show us that if you give Americans money, they will spend it. Now, we have been spending some of the stimulus, but sitting on an impressive amount of it, a much greater amount than anybody originally anticipated. And it shows you that the average consumer in this country is not prepared to sort of say, blow the all clear signal, so to speak. There's still a fair amount of nervousness, trepidation, etc. And you're seeing that show up in savings rates and the lack of new debt. And this is really interesting. We've not seen this in prior cycles. You can see money market levels, right? Both retail and institutional money markets. We've actually got about $6.5 trillion in all types of savings right now, including checking accounts. We peaked at about 8 trillion during April, May, June of last year. So we've spent some money, but we are way, way above historical levels of savings. As a percentage of the US economy, we are still right near the all-time record of the amount of cash that's just being parked. Okay, so how does that translate then into inflation, right? And this is the number one question on a lot of people's mind is, with all the creation of new dollars and the giving it out in stimulus, isn't that inflationary? Well, remember, there's two components to inflation, right? The addition of dollars, and we have seen a 30% increase in the amount of US dollars in existence in just 1 year, right? So we created a lot of dollars out of thin air. Okay. But in and of itself, that is not inflationary. Until the velocity of those dollars goes up, you don't have inflation. And we saw a complete collapse in the velocity of dollars. I just showed you why. Let's go back. Why? Because everybody's sitting on a high percentage of their dollars. Even people that didn't get stimulus checks spent a lot less money last year. So you had a reduction of debt and a real increase in the amount of dollars being stockpiled. So we're not yet seeing broad sweeping, inflation. I'm going to talk about that more in a minute. We are seeing inflation, but not crazy levels of inflation. And on par, you're seeing velocity of these dollars still sitting very low. Now, that will not stay that way. We will go through a period where people start to feel a lot more relaxed and they start getting more aggressive with their dollars. They will buy more, invest more, grow businesses, start businesses, etc. But for the moment, this is really, really impressive data for the health of our economy. We are exactly in the opposite spot we were in the financial crisis. The average household, the amount of their assets, their liquid assets, not their house, their liquid assets compared to their debts, has never been higher since we have tracked the data. This is impressive. So the value of your stock portfolio went up. The amount of your checking account, your savings account, your money market accounts went up, and your debt stayed flat or went down, right? So we're seeing households that are in really, really exceptional condition right now. Here's another reason: total revolving credit in the system. We have not wanted to borrow more money. And this has been a trend since the financial crisis started. We normalized some, but in general, this trend has been lower. And in fact, the trend has been lower since the 80s. Now, this is really interesting because the cost of borrowing has gone down, but also our desire to increase debt continues to go down. We are not, as a society, wanting to load ourselves up with more debt. That's a very healthy thing, very good for the economy. Here's another way of looking at this. Average household net worth, okay? You can see what it has done. That's the blue bars. Other than this dip during the financial crisis and a little dip again last year, net worth in the US continues to go up. Financial assets, right? Your stock accounts, your 401ks, your real estate assets, making another high, finally getting back above that level from 05, 06, 07, right? But look at debt, not moving. That purple line has not budged in 15 years, call it, right? So this is really constructive. with debt being so inexpensive, it's so cheap to get a mortgage, a car loan, etc., the amount of debt has not been growing. It's a great, great sign. So let's talk about housing for a second, okay? This is the real culprit in the housing issue. Everyone's talking about a bubble. Is there a bubble in housing? Okay, I don't know. You don't typically know until the prices finally go back down later where the top is, right? Everybody wants to know where the top is. But here's some things we do know, and you can't cheat this data. The amount of inventory has completely collapsed. There is never, since the data has been tracked in this country, has there been so fewer homes for sale compared to the number of adults, and not even close. We went through a decade after the financial crisis where we did not build very many new homes in this country. And now you have people wanting to get out of the city, right? As soon as COVID hit, with all these people, they want to get out of the city. Mortgage rates are 3%. You have a lot of people in their 20s and 30s finally getting off their mother's couch and moving out. So you have a confluence of events that has created a run on the limited amount of housing that's out there, right? And so this is a supply and demand issue, is really what we're facing here. Now, there's a lot of worry about this bubble in real estate, okay? But I want to show you something that will help you feel a little bit better about what housing prices have done and why it's a lot different than the financial crisis, which started here, okay? If you'll notice, a really high percentage of all of the mortgages being issued right now are the very highest credit scores, okay? And what it is not is what it was during the financial crisis buildup. It is not subprime. It is not speculative mortgages. These are the people with the most bulletproof balance sheets, are the ones that are fueling this rally in housing. Okay, here's another way of looking at it. Okay, in 2005, there was a point where 23% of mortgages were being given to people with a 760 credit score or higher. Well, look at it today. It's the opposite extreme. We had a tick early in the year of 73% of all mortgages going out the door were to the highest credit scores, right? So here's another way of looking at this. In 2007, right before the financial crisis, there was $10 trillion in US home equity, okay? But there was $9 trillion in mortgage debt. Look at today. Home equity has more than doubled. Can you think about that? Okay, in the history of the United States, in a 13-year window, we more than doubled the amount of home equity. That's a massive, massive move. And mortgage debt has barely budged. It's gone from 9 to 10 trillion, okay? So it is not what it was in 2007, which was a debt-fueled real estate rally. That is not what's happening. Prices are up, but debt has barely budged, okay? So I'm not showing you this data to say that real estate prices aren't coming back down. I have no idea. But the underpinnings, the foundation of what's going on in the mortgage and real estate market is exactly the opposite as it was of 2007. We were in a speculative, debt-fueled housing boom going into the financial crisis, and we are in a supply-constrained, cash-driven, high-quality buying environment right now. So very, very different. Okay, that's a lot of good news. Okay, let's talk about what we don't like that's going on for a minute, okay? Number one, things aren't cheap. Nothing is cheap. Now, I have no clue what stock or housing prices are going to do in the next 1 year, in the next 1 day. I have no clue. I've been in this business for 29 years. I'm a former trader on the New York Stock Exchange. Nobody has any clue what tomorrow's prices hold. Okay, so we can only control what we can control. But what's interesting is that for 1 year, how expensive the stock market has been very, very elevated. We went from very low, how expensive stocks were, to very high from March to March. Okay, now here's something interesting though. In this window, since the fall, the stock market's gone up another 30% since fall. but the market hasn't gotten any more expensive. Okay, why is that? Well, that's because I showed you earlier how much earnings have gone up since the fall. Okay, so what's happening is, yes, the market's going up a lot since last year, since last summer, but the market's not getting more expensive. It's staying at this elevated level because the earnings are catching up very quickly. So I want to show you that you can have periods. This was one of these periods. See this here? The market went up during that window of time, but the market also got cheaper. Isn't that weird? So we very easily could see the market get cheaper, but prices continue to stay the same or go up. Earnings are a massive, important factor in how expensive the stock market is. But we can't kill ourselves. The market is not cheap. And because it's not, we have to be prepared for volatility. You know, yesterday and today, the stock market's getting knocked around a little bit. I wouldn't be surprised at all to see the market have a 5, 10, even bigger pullback sometime this year. It is the nature of markets. And we need to kind of work off some of the weirdnesses in this market, right? There's some other things we don't like. Inflation is here. The Federal Reserve is trying to convince us that it's not. They love to change their multipliers to show us that inflation is still at 2%. They're heavily biased. We have inflation, okay? One of the key reasons we're seeing some inflation is because inventories are so low. Last year, we had the double problem of having a recession in the spring because of COVID, but also we shut everything down. So there was no inventory. So now we not only open up, but we open up way hotter and way faster than anybody anticipated. And now there's a run on everything: cars, houses, right? Travel, you name it. So you now have an explosion of prices because there wasn't any inventory around. And in about 40 years of tracking this data, we got to the smallest inventory levels we have ever seen. And now this is broad. This is inventories of all manufacturing and supplying in the United States, okay? Hey, there's just nothing to buy. So I talked about with housing, there's nothing to buy, but there's nothing to buy anywhere. It's the same problem in autos and everything else, right? Even washers and dryers, refrigerators, you name it, we didn't have the inventory, okay? Let me show you who else got caught flat-footed. Try and get yourself a container coming out of China. It's never been so expensive. So you want to ship goods, these guys got caught flat-footed also. So it's very expensive to ship. There's never been so few truckers available in the United States, okay? That's expensive. There's inventory sitting around all over the place on docks and on ships that can't be moved at the moment because we actually don't have the truckers, right? Okay, third problem, okay? Now, this is a problem we are creating ourselves, and our politicians are going to have to fix this, okay? Historically, let's look at the yellow line here. You see the yellow line? This is the peak of the financial crisis, and this is the peak of COVID, and here's the peak of the dot-com recession, okay? That's unemployment. That's what we call U6 unemployment. That's official unemployment, okay? So, of course, in a recession, unemployment peaks, right? And then as the economy recovers, then unemployment goes down. We all understand this. Now, the white line is business owners, small business owners in this country, reporting how easy it is to hire. So, of course, when there's a lot of unemployment, right, it's easy to hire, of course, because there's people everywhere that need a job. So small business owners, they don't have a hard time hiring. Can somebody explain why you're seeing all-time high unemployment in COVID and all-time high difficulty in hiring? Okay, this is a problem, okay? We have now paid people so much money to sit at home on their couch that the companies wanting to pay $15 an hour to employees, they have no one to hire. Because many people have chosen to sit at home, collect a stimulus check, and not take the $15 an hour job. This is a problem. This needs to be fixed. And our elected officials in Washington are going to have to figure out how to fix this. I don't have a lot of confidence in them. So what it's doing is we just saw the highest quarterly jump in wages ever. So we just saw a massive jump in wages this past quarter. Because if you own a business, you have had to pay more money to get people off the sidelines and come to work. Okay, if we are not careful, this is going to continue to skyrocket. It's going to hurt earnings. It's going to hurt companies. This is a difficulty. Okay, so the stimulus is going to have to start to roll down to a certain extent so we don't murder all of the companies in this country that employ people. So this is something we definitely want to keep our eye on. I talked about this already. Here's lumber prices. Here's steel prices. The recovery is happening so fast that we got caught flat-footed. So we got to get more supply online, get more lumber out there, get more steel out there, get more copper out there, right? It's coming. This happens after most recessions. But you can see after the last recession, it was small, right? Not this time, right? Steel's kind of cut off there. But this time it's big. And so we've really got to work to let our companies run, let them open, let them manufacture, so that we can, provide materials to people that need them in this country. Okay, the next thing, higher rates, higher interest rates, they're coming, right? The Fed is indicating they won't raise rates to 2023 probably. I suspect we might not make it out of 2022 without higher interest rates from the Fed. But nevertheless, what happens to the stock market when rates go up? Okay, this goes back to 1960. You can see these are all of the cycles where the Fed was raising rates. On average, it lasts about 26 months for the cycle of the Fed slowly raising rates to try to cool off an overheating economy, okay? And on average, 10-year yields have gone up about 3% in those times. Now, there's some outliers in there. The Fed's gotten a lot better at smoothing this out. It used to be a lot wilder how they dealt with interest rates. We're getting a little better at this job. But what's interesting is over the next year, the stock market has gained an average of 17% per year during these cycles of raising interest rates. So there's a narrative out there that says rising rates are bad for stocks. It's typically actually not true, because the first part of a rate increase is because the economy is thriving. So the companies are thriving, the earnings are thriving. So you're getting a stock market that's actually performing better, right? So don't automatically fear rising rates. Historically, it's only been in the periods where rates got really high, okay, 70s and 80s, that it really started to hurt the market because the interest rates were so high that it really was starting to hurt every corner of the economy. So something for everyone to keep in mind. All right, my last real worry, okay, zombie companies, okay? We have reached a place that I thought was impossible. 17% of publicly traded companies in the United States, okay? Just the cost of their debt is more than their profits on a quarterly basis. These companies, if they can't borrow, they're bankrupt. Okay. This was never the case. You go back to the early 90s, look how few, and this trend continued back 80s, 70s. Okay. So never in our lifetime have there been so many companies that are the walking dead. That's why they call them zombie companies. These companies probably should be bankrupt. This concerns us because there's a lot of garbage companies out there still operating, and you can still buy their stocks and bonds. So it has never been more critical to be careful to own what we call in our business high quality companies, okay? High quality is not a commentary about their brand name. Hertz Rent-A-Car is the biggest in the country. They went bankrupt last year. They were bloated with debt. They were a zombie company. So when we talk about high quality, we're talking about high quality balance sheets, high quality financials, really well-run financial businesses that when the economy goes into a recession, which it will, many of these will go bankrupt, okay? So it's never been more important to be careful and understanding about what you own. And there are a lot of bonds. Here's the triple C's out there. There are a lot of junk bonds being issued of companies that are zombie companies. Okay. So just because you own a bond fund doesn't mean the bonds in there are safe. And this has never been misunderstood as much as today. So you want to talk to your financial advisor. You want to really pop the hood on what you own, okay? Because in the next bad recession that we have in this country, a lot of these companies are going to be wiped out and your bonds will go to zero, right? Bonds can go to zero. Stocks can too. So you want to really be careful about what you own. Own high quality, right? So in closing, David, here's kind of our game plan here. These are the things we like. We've talked about this. Earnings are good, stimulus everywhere, cash everywhere. Interest rates have never been lower. Such a blessing for us. Balance sheets are, for the most part, very good. The vaccine is really unleashing a lot of pent-up demand. We worry about things being expensive. We've priced in a lot of perfection, right? This weird unemployment wage problem we're facing. Tax rates, we didn't really talk about that today. We'll get more color on that in the future. I know David's going to have a quarterly call on this coming up as well. And then zombie companies, right? So you want to rebalance as you go. Be disciplined. There's a lot of junk that's rallying. There's a lot of weird things out there, from cryptocurrency to weird types of stock rallies and things like that. Just be careful. Just stay balanced in your approach, disciplined in your approach. Don't abandon really high quality assets. It doesn't mean you can't have part of your portfolio in speculative things. That's great, but just be really careful about chasing junk. A lot of that stuff will vaporize in the next recession. And then we want to be expecting volatility, right? You might want to keep a little bit more cash and safe assets around, maybe more so than you did in the past. And again, own those high quality assets. Be careful with the indexing and really maintain that long-term plan. I want to close with one chart that always blows people's minds. I always hear when the stock market is making new highs, that probably means you should sell. A thriving stock market usually is not a bubble. It's usually indicative of a very healthy, surging economy. So here's some really interesting data. If you go back 32 years, okay, and you invest in any random day in the S&P 500, then your returns for 1 year, 3 years, 5 years are listed, okay? So any random 3-year window would have returned you 39% return. But what if you had only invested on days that the S&P 500 is making an all-time high? Well, the next 3 years would have been 50% return. It actually would have been better. I know this seems very counterintuitive because you always think, oh, I want to invest when things are down. Well, that's true. We do want to invest when things are on sale. But what it also shows you is if you just happen to be a bad market timer and you invest some on a day that the market makes a new all-time high, well, your forward returns are actually pretty dang good. Usually strength leads to more strength. Economically, that has always been true. And there's some other kind of cool stats. Since 1928, the S&P 500 has posted an annual gain of 30% or more on 18 years, or 20% of all years, right? Here's something that's interesting. In the last 70 years, the S&P 500 has actually spent a third of its life within 5% of its all-time high. Because if the market averages 10 or 11% return per year, it's got to be spending a lot of its time near the highs, right? Sort of mathematically. So don't just be scared out of really good investments because the market is near or at a high. Anyways, just thought I'd share that. I think, people find that interesting. And David, that's all I've got for prepared comments. I think you might be on mute there, bud.
Yeah. Hey, thank you, Kurt. I don't see any questions in the queue. Tell me really quickly, I get a lot of questions about crypto, of course, these days, and gold as a hedge against inflation. Now, crypto is far more volatile from what I've seen than any asset I've seen in a long time. So as a hedge for inflation, I'm not very convinced on that. But what are the best hedges, given the fact that a lot of people are expecting inflation? What do you think the best hedges are for that?
Yeah, we put out a white paper this last year on this that's pretty in depth. We spent about 6 months researching it and writing around this. and you're welcome to send it out to your clients. What's really interesting is if you go back a couple hundred years, both in Europe and in the US, the number one best asset hedging inflation, believe it or not, has been stocks. And one of the reasons that is because when there's inflationary periods, earnings usually are really going up a lot. I'll give you an example. When the economy's thriving, a company can pass on the increasing cost of resources to its customers. Look at what you'll pay for a cell phone now. Think about what you'll pay for your iPhone now compared to what you paid 10 years ago. I mean, it's astronomical. I would never let my cell phone bill go unpaid, right? I'm going to pay this thing, right? So good businesses can really pass this on to consumers. Another one is raw land. Raw land actually is the second best inflation hedge of all time. Now, gold is a great inflation hedge, but in a crisis. So if you go back and look at crisis periods, and they're usually short, 6 months to a year, gold is a great hedge. People freak out and rush into gold. They push the price up, but it actually has not been a very good enduring inflation hedge over time. Crypto is a whole nother animal. It is not an inflation hedge. Crypto is like the internet. This is my opinion. We have a report out on crypto as well. But remember in the 90s when we all knew the internet was going to be a big deal, but we didn't know how exactly it was going to be a big deal. So you didn't know exactly what to invest in and where to buy. Blockchain technology is like the internet. It's amazing. It's spectacular. It's going to have incredible ramifications, but we don't know how yet. We don't know where the puck is going to quite yet. So we encourage clients to have some exposure, but diversified and not too much exposure. If you just had a little bit of exposure to the internet in the mid-90s and you own a basket of different assets, you did very, very well. But if you rushed in and you bought one.com, pets.com, you blew up and went to zero. You lost everything, right? I mean, and everybody thought pets.com was going to be the greatest thing since sliced bread, so.
That's right. That's right. All about the domain name back in that day.
I know. I was.
Yeah. Well, hey, Kurt, thank you for your time. We're recording this. We'll send this out to people that have been online and others who were unable to attend. We'll be doing this quarterly, so I hope that people will be able to make some time for it in the future. And the most important thing, we don't have any questions now, but a lot of people probably are thinking, what does all this mean to my portfolio? What does this mean to my planning? How can I make adjustments for what I see things going on? That's something that we can get together, discuss how we can adjust your portfolio to things we see coming along, and adjust to your risk tolerance. And we've got tools for every risk tolerance out there. So look forward to meeting with people who get this information and would like to discuss it more. And in the meantime, we'll be doing this on a regular basis. But thank you again, Kurt. Appreciate your time.
Great to be here. Great to be here.
I hope everyone has a great rest of the week.